Okay, let's go ahead and post our credit card transactions. Again, we're still using credit card module here. Going forward, we'll show you other ways to do it. So this is a purchase. That's our credit card. Okay, we're buying professional library items here. Yep, that's professional library. It's an asset. What's happening here? Well, our professional library is an asset. Assets are increased when debited. What else is happening? Well, we essentially bought it with a credit card, so for now, our debt increased and basically our liabilities went up, therefore it has to be credited. There it is, debits and credits are in balance. This amount right here, it's a debit to account 1400, and this amount right here is a credit to account 22,100. Let's keep going. We have some office supplies. Let's see. Office supplies. There it is. Office supplies is an expense. Expenses go up when debited, just like assets. Makes sense, right? There it is. And then we just change amounts, of course. 173. There it is. Debits and credits are in balance. This is debit to 61,500. This is credit to 22,100. Saving you. Again, we have some food items for our office. To me, that would be part of the office supply, so that's going to be like this. We don't need to itemize it. Typically, you would itemize it if you were in business of selling those items and keep track of them. But anyway, Food Mart. All right, it's 4/10/2021. Reference number. Okay, 38828. There it is. Office supplies works for me. Yep. This is debit. This is your credit. Good to go. One more. And again, we have office cooler refrigerator, office coffee dispensing machine, office water cooler dispenser. All right, so we're getting some equipment. All right, let's book that accordingly. So we know our assets will go up. All right, furniture and equipment. I mean, we could essentially book them all as lump sum, or we could segregate them. Doesn't make a difference. For tax purposes, we would have to identify them. So, cooler, refrigerator, furniture and equipment, right? That's part of furniture and equipment. That's coffee machine. Oh, that's one industrial coffee machine. Oh, but no, then we have to allocate shipping and handling to each one of them. Yeah, let's just avoid that and book them all into and then we can depreciate them all as a lump sum because again they're actually part of one installation, right? Because the water is being filtered, so it's coffee and water station. Coffee and water station. That's it. We can call it as such. Lump sum it includes sales tax and shipping and handling into it. It has to be capitalized. And what happens here? Again, our asset goes up and our liability goes up because we funded purchase of these assets of this coffee machine with water system, coffee and water station by borrowing. There it is. Debits and credits are in balance. This is debit to account 1500, 15,000, the furniture and equipment. It's an asset. Assets go up when debited. And this amount is a credit to account 22,100. Our credit card, it's a liability. Liabilities go up when credited. That's it. We're going to save in new, and I'll tell you why. Because we also have a return, and we return some office supplies here. What happens? You stay on this interface, you click this button, all right? So just a few seconds ago, this window right here, this little interface was credits for 22,100. The moment we click this becomes a debit. So, okay, office supplies. There it is. Oh, there it is. Okay. So 61. So in this instance, expenses are reduced, right? Because we thought we needed that sweetener packs, but we didn't need as many, so we returned it, so our expenses declined. Expenses decline when they're credited. What else is happening? Well, that money will be refunded by the merchant provider to our credit card company, and therefore our liability will be reduced. So this is a debit to this account now, 22,100, and therefore reduces it. There it is. Debits and credits are in balance. Save and close. All right. Next, we have transfer receipts. Again, that's the payment for our from our bank to our credit card. And we can just show it here. What's happening before we interface it. Bank account will be reduced, therefore it has to be credited. Liability as a result will be reduced as well. Therefore, it has to be debited. How can we do it? We can do it with, for example, transfer funds, but we can also do it through check interface. Let's just do it with this, and then going forward, we'll start playing around. General bank account, credit card. There it is. This amount right here, what is it? It's a credit to account 10,100 because 10,100 is an asset and it is being reduced when it is credited. And this amount at the same time is a debit to account 22,100, which is a liability, and liabilities are also reduced when debited. So we take money from here to pay off this credit card, right? And save and close. That concludes booking credit card transactions for April. Next, we have our invoices from our vendors that we pay using our checks, and then we'll reconcile, and that will conclude April.